This is Boom Bust, and these are the stories that we're tracking for you today. First up, former Treasury Secretary Larry Summers marked President's Day on Monday with a warning that the U.S. is headed towards a turn-of-the-century British economic policy. I'll tell you all about it coming up. And then we have David Stokman live on today's show. I'll be asking him about Fed policy, debt, and laissez-faire capitalism. You won't want to miss it. And finally, in today's Big Deal, I'm joined by Boom Bust's favorite Rachel Kurzius. We'll talk about a new book that's making waves in the financial industry. Plutocrats, beware. It's all coming up, and it all starts right now.
An aristocrat with no servants is as much use to the county as a glass hammer.
Ah, Maggie Smith, what a wonderful lady. Just love that. That was Downton Abbey, and I truly do love that show. Now, Downton depicts the lives of an aristocratic family and their servants in post-Edwardian-era England. Now, before I get started, I want to make it very, very clear that this is a fictional television show about the lives of upper-class Crawley family and the British social hierarchy that surrounds them. Now, just yesterday, former Treasury Secretary Larry Summers wrote an editorial in the Financial Times, a British publication, just side note, warning that the U.S. is headed the way of Downton Abbey with the economy and social inequalities to match. Now, Summers says the solution to avoid this must involve raising incomes of the middle class and the poor and reforming tax codes. Tax codes that let a big share of the wealthy income escape taxation. Now, Summers writes, quote, the current tax code is so badly designed that it is very likely to be having the effect of reducing economic growth. It also allows the rich to shield a far greater portion of their income from taxation than the poor. For example, last year's increase in the stock market represented an increase in wealth of about $6 trillion, of which the lion's share went to the very wealthy. Now, here's the thing. If anybody besides Larry Summers were to write this editorial, it probably would have landed better. Now, Summers is the guy who pushed for the repeal of Glass-Steagall, who deregulated the derivatives market, and who Sheila Bair wrote, quote, was part of the deregulatory cabal that got us into the 2008 financial crisis. Now, this is the same financial crisis that increased the gap between the haves and the have-nots. Summers is one of the haves with a fortune estimated to be between $17 and $39 million amassed by consulting for financial firms like Citi. Now, Summers went on to write that President Barack Obama is right to be concerned. Those who condemn him for tearing down the wealthy and engaging in un-American populism are, to put it politely, lacking in historical perspective. Now, kind of like the pot calling the kettle black a little bit, Larry, no? Especially when your historical perspective is based on that of a fictional TV show.
She only tried to give me orders.
You mean she mistook you for a servant?
But he's a servant.
Don't tell him that. He'll never get over this shock.
OMB Director David Stokman joins me now from our New York City studio to discuss U.S. budget deficit, Fed policy, and much, much more. Now, welcome, David. I want to jump right in and start off by asking you, a lot of people that we've talked to recently on our show, they're concerned about the destabilizing effects of buoyant assets right now. Is this something that you're concerned with personally?
Very much, but let me observe first that Larry Summers should know about fiction. He's been dispensing economic fiction his entire career and is behind the policies of unlimited money printing that are behind this huge windfall that has gone to the 1%. After all, when the Fed keeps the money market rate at 0 for 7 years, which is its current policy, and Yellen has reaffirmed that, it is essentially creating free money for the carry trades to engage in every kind of speculation known to man all over the world, planning dangerous time bombs, financial time bombs, that one of these days will go off. Anything that can be traded, repoed, securitized, options, the fast money and the hedge fund traders are doing, all on the back of the free overnight money that is being dispensed to Wall Street by the Fed, and which they're guaranteeing to keep in place for several years yet to come. This is the cause of the problem. We don't need to change taxation. We don't need to have more Keynesian type, middle income oriented manipulations. We need to get the Fed out of the financial markets, its fat thumb off the scale, let interest rates clear the market based on true supply and demand, let traders and speculators be at risk, shut down the Fed-fueled casino, and we'll solve the problem that he, purports to be addressing.
So you obviously think that the Fed's accommodative monetary policy is a big reason why the asset markets might be so buoyant right now, correct?
Yes, of course. I mean, the Fed is fueling massive inflation, but it's inflation of financial assets, not inflation of goods and services. And but it's equally damaging. In fact, it's even more so because this huge inflation of financial assets. Take one measure. The Russell 2000, which is the index of the most speculative and the higher beta stocks, so-called, Main Street, America's small mid-cap companies, is now trading at 85 times trailing earnings. That is lunatic. That is absurd. That's what you get at the peak, like we did at the dot-com peak in 2000, early 2000, or at the peak of the market in 2007 before the big crash. So the handwriting is all over the wall. There is really extreme speculation everywhere, and yet the new Fed chairman testified last week that she can see no signs whatsoever of not only any red flashing lights, but orange ones as well. And I think that's just a measure of the fact that the Fed today is being run by academic zealots who do not understand that they have fundamentally crippled and disabled the financial markets and created a casino that is dangerous and is nearing the end of this bubble inflation.
Then I have to ask you, do you believe destabilizing bubbles are one of the principal problems for the U.S. economy right now?
Absolutely. It's the heart of the problem. The Fed has become a serial bubble machine. Look at the record from '87 and look at the panic in 1998 when they bailed out long-term capital and created the great moral hazard and the speculative final blow-off of dot-com. And then Greenspan panicked again, put the interest rates down to 0 or 1%, said we have your back, the so-called Greenspan put. Then we got the housing bubble and the credit bubble and the Wall Street bubble, and then the meltdown in 2008. And then they implied that they didn't know where it came from, but they were going to do even more when Bernanke opened up the monetary spigots and drove the Fed's balance sheet, as you know, from $900 billion on the eve of the breakdown or of the Lehman bankruptcy to pushing $4.5 trillion before they finish tapering, and frankly, they're likely to keep on going beyond that. So that's the heart of the problem. When you have these massive cycles of asset inflation, sooner or later they collapse. It creates panic throughout the economy. Activity freezes up, comes to a halt, and you start all over again. The Main Street economy since 2000, when this bubble pattern really emerged, has been growing at the lowest compound rate for 13 years, about 1.7% of any time in the last 100 years. That's how bad the negative impact is.
So, David, I think it's fair to say that you think the Fed should raise rates then, but I want to ask you, what should they raise them to?
No, I don't. Can I just jump in there?
Please.
I don't think the Fed should raise the rates. I think the Fed should get out of the market, get its thumb off the scale, let the market clear where supply of savings and demand for credit intersect. And I don't know whether that's 8%, 4%, or even, you know, not that much higher than it is today. But I do know what's out there today is totally artificial. It's set by the Fed. They say they're pegging the rate, they're fixing the rate, and the entire market is now trading against what the Fed is doing, may do, the word clouds that come out of the Fed speakers, and not doing its job of price discovery and finding a balance of supply and demand throughout the money markets and throughout the debt and equity markets.
Now, I want to ask you about this. Fed Chair Janet Yellen, she has said that she is concerned about bubbles, but she and other Fed officials have also said that they feel compelled to keep rates low and even to continue asset purchases because unemployment in the U.S. is elevated while consumer price inflation remains low. What can the Fed best do to support employment, given its dual mandate to support employment and price stability?
Well, the dual mandate is just an excuse, a pretense. The dual mandate was adopted in 1977, so-called Humphrey Hawkins. It was in place when Volcker basically slammed on the brakes and forced the economy to go through a cleansing in order to purge the runaway you know, inflation of commodities and goods. So there is nothing in the statute that says the interest rates have to be at 0 through 215, that they need to peg the 10-year rate under 3% or whatever they're doing. The mandate is so vague, elastic, and generalized that it provides scope for the Fed to run a sound money that allows the market to discover the correct pricing of money and debt and equity securities and options and all the rest of it, rather than trying to dictate it and run what I call a monetary central planning system from the Eccles building, which is totally impossible. Look at how wrong they have been in their forecasts, going all the way back to subprime is contained and there's no recession coming and we're now going to have a booming recovery. None of that has happened, and it proves that their models are no good. They ought to be trash canned, and they ought to get out of the business of trying to drive the economy. What I say is, we need regime change. We need to get the money printers out of the Eccles building. We need to get people on the Fed board who understand that you've got to let markets work. You've got to let you know, millions of investors and traders and borrowers and lenders determine what financial prices and values ought to be.
Maybe someone like you on the board. But David, don't go anywhere. We have to take a super fast break. And you out there in TV land, please don't go anywhere either, because more with David Stokman when I return. Then, in today's Big Deal, I'm joined by Madame Curzius to talk about plutocrats in drag. Yeah, plutocrats in drag, true story. But as we head to a quick break, here's a look at some of your closing numbers at the bell. Stick around.
Patients are force-fed.
Two explosions near the finish line of the Boston Marathon.
More than 1,000 people have gathered.
What is the latest that you're hearing about the number of victims?
Back now with more from Mr. David Stokman. Now, David, I'm going to jump right in. I'm going to ask you, do you share Ben Bernanke and Janet Yellen's deflationary fears?
Deflationary fears? Absolutely not. That is just a canard that they constantly trot out when all else fails to justify continuing to run the printing press at these crazy rates, even $65 billion a month. After all, we're in the 5th year of this so-called recovery. Look at the last 12, 13 years. The CPI has averaged 2.4%. If you take the one they prefer, you know, the PCE deflator, less food and energy, assuming no one has had to heat their home or eat for 12 years, but even then it's 1.8%. The rates do bobble up and down a little bit by month or quarter, depending on what's going on in the world economy, commodities, oil, and a lot of other things. But on trend, there is absolutely no whiff of deflation in the air. And besides that, where was it ever written that if you don't make 2% inflation, you're failing to help the economy? I mean, inflation is all for debtors and is a huge negative and harm to savers. And the Fed has decided to weigh in on the people that want to borrow, build up the debt, and it's just a doctrine that is erroneous and leads them to what I think are really very dangerous policies. They ought to get out of the way, let the market work its will. There is so much capacity in the world today that inflation isn't a risk in my judgment, nor is deflation. And we've got to somehow liberate the financial system from the domination of this monetary Politburo that's trying to run the show in the Eccles building in Washington.
Now, in a previous interview with RT, you said that in your experience in private equity, it really convinced you that debt and leverage were big problems for the U.S. economy. Can you explain how you came to this conclusion?
Yeah, I mean, all you have to do is look all around you. The companies in America today are not really investing in the future to any great extent in terms of new technologies, plant and equipment, and tangible assets. They're essentially borrowing money that is really cheap because the Fed is repressing interest rates and using their borrowings to buy in stock in an effort to pump up stock prices and therefore the value of management options. But this essentially accomplishes nothing for the real economy. It's just financial engineering. All of it is being fueled by the Fed. The same is true with all the LBOs and the leveraged recaps and so forth that are going on. It is tilting the balance towards massively leveraging up the entire business system. Now, they tell you that there's all kinds of cash on the sidelines and the corporations are unusually liquid. Well, that may be true for the top 10 or 50 or 100 big cap international companies that have a lot of cash abroad that they can't even use. But if you look at the business sector as a whole, there is $13 trillion of debt on incorporated and unincorporated business in America. That compares to less than $11 trillion at the time of the crisis. So business hasn't delevered. Business has actually increased by nearly 20% or $2 trillion the amount of debt they're carrying around. And the debt has not been used to acquire tangible assets and to invest in productivity and growth and jobs for the long run, but simply to fund financial engineering like M&A deals based on cash and stock buybacks and one-time special dividends and all the rest. Again, that's part of the negative consequence of what the Fed's doing. When you couple that with the fact that debt is tax deductible to business and equity capital isn't, you so tilt the playing field that we're turning, as I've said, the entire U.S. economy into some kind of collective leveraged buyout. And it's dangerous, and it's one of the reasons why we have the huge problems that we're facing today.
Now, I don't know if it's a draw for you, but are you more concerned with public debt or with private debt today?
Well, I'm concerned with both, and that's why when we look at the balance sheet, you should measure something the Fed itself publishes, which is called credit market debt outstanding. That includes household debt, mortgage and consumer, business debt of all kinds, short-term, long-term, financial institution debt, and public sector debt. And when you add it all up, today it's a startling number, 58 trillion. It is 3.5 times our national income. That is near an all-time high and is dramatically above what it was prior to 1980, when the ratio of total credit market debt to national income was more like 1.5 times. So that's the measure of the problem we have, and it's spread into all sectors of the economy, mainly under the doctrines of, you know, the Larry Summers and the Paul Krugmans of the world, who insist you can't have enough debt, whether you're a household or a government. And I submit you have so much debt today that it's a clear and present danger to our capitalist economy.
Now, we only have about 1 minute left, but I want to ask you super fast. We spoke with your former Reagan administration colleague, Paul Craig Roberts, last week, and although he didn't discuss it during the interview, I know he wrote a book on what he calls the failure of laissez-faire capitalism. Now, his view is that we have a sort of crony capitalism in play dominated by vested interest in large corporations rather than a real capitalism that can spur growth. What is your view? We have 30 seconds. I'm so sorry. That was a long lead-in.
Yeah, I agree with that. I agree with that. I think the problem is overwhelmingly crony capitalism. That's what the bailout of all the big banks and Wall Street and Goldman Sachs and Morgan Stanley and AIG and all the rest of them was in 2008. In my book, The Great Deformation, which I put out recently, I refuted all of the urban legends on which that was based. But if you look at Washington today, it's a money machine where the interest groups come in and try to get their hands on the taxing or subsidy or regulatory power of the government to get outcomes in the economy that they wouldn't obtain in the free market, like, you know, like the UAW bailing out GM. So yes, capitalism is being corrupted. We don't have honest capitalism. We have crony capitalism. The Fed and Keynesian philosophy are the primary source of that tremendous damage that is being done.
David, thank you so much for your time and your insight. Come back anytime. That was David Stokman, author of The Great Deformation. Time now for today's big deal. In today's big deal, Rachel is back, Madame Curzius, and we're here to talk about Wall Street's secret fraternity. True story, secret fraternity. Now, many of the barons of Wall Street, they come from Ivy League fraternities and secret societies, Skull and Bones being the most well-known among them. But journalist Kevin Roose found his way into an annual black tie induction ceremony for Kappa Beta Phi. Now, a frat with a decidedly older median age group than most Dartmouth Greek houses. Now, he detailed his experience in an article, 1% Jokes and Plutocrats in Drag, what I saw when I crashed a Wall Street secret society. Okay, now Roose saw some of Wall Street's most powerful wearing leotards and gold sequin skirts and costume wigs. Yep, try and get that image out of your head. Sorry, it's going to be hard. Rachel, tell me more about Kappa Beta Phi. What's the group's history? What's the deal with them?
Yeah, so it's essentially they switched the name of Phi Beta Kappa, which is the name normally for honor groups. And there used to be a ton of these societies. Now there's just one left. It's Wall Street, and it's essentially like a friars club, right? So they make jokes at one another's expense, and sometimes at the expense of politicians and regular old schmoes.
Now, who are some of the famous members of Kappa Beta Phi?
Yeah, so Wilbur Ross was what was called the Grand Swipe, which was somebody who's kind of the master of ceremonies. But there are others like Michael Bloomberg, who wasn't in attendance when Kevin Roose went, but is a member. John Corzine hasn't been back since he kind of embarrassed himself, but he's Alan Greenberg of AIG, Sally Krawcheck, Vikram Pandit, Larry Fink. These are just a few of the many members who have been around. I mean, This organization has been around since the Great Depression.
It's incredible to me. Like, all those names, you know, you ask the question, does, I'm going to get it wrong, Kappa Beta Phi, now I'm thinking Phi Beta Kappa,
right.
Kappa Beta Phi, do they have any sway over the global financial markets?
Right, so not as a group, because they're essentially together to have a good time, essentially throw petite fours at one another. That's actually something that they do. But Roos makes the point that if there had been something that had happened at the St. Regis where this event had taken place, global financial markets as we know them would have totally melted down because all of the people who comprise them and are making these major decisions would then be gone. So the group has all the powerful people, but they're not making decisions there except the one thing would be it's kind of a sign of your success to be inducted into this group. So it's kind of a who's who of Wall Street, and then of what they call Montgomery Street and Spring Street, which are kind of the offshoots.
And
other
what are
major
they?
financial
Montgomery
centers.
Street?
Montgomery Street is San Francisco's, the Wall Street of the West, and then Spring Street is Hong Kong.
Oh, that is a Jeopardy factoid if I've ever wished for one. Now, I have to ask you, what were some of the skits that Roos saw?
Right,
Can you
so
describe
Roos watched all of the members who get inducted have to do a lot of musical skits in particular. Some of them were doing kind of jokes from the Book of Mormon, but it was kind of a parody skit. A lot of them were doing jokes, often at the expense of people like Hillary Clinton and Barney Frank. Barney Frank in particular, someone who they saw as pushing for financial regulation. A lot of jokes. Now, this was from January 2012 when he went. So there were a lot of jokes at the expense of Occupy Wall Street, which was still kind of occupying physical space at that time.
Close to Wall Street. Now, what was Roos's conclusion after these proceedings? What did he think? What did he come to?
Well, he said that this was kind of an indication to him that these financial titans were very disconnected from the world they surrounded themselves in. He made particular mention of the fact that they were making fun of a lot of people when they got a bailout, for instance, and mainstream America did not. So he said, quote, the upper ranks of finance are composed of people who have completely divorced themselves from reality. He got busted trying to leave, and they offered him essentially, if you keep your mouth shut, we will give you inside scoops on a lot of information. He decided to publish the story. I think we're all better for it.
And I'm excited to read the book and hear more. Rachel, as always, you're fantastic. Thank you for joining us.
Yeah, thanks for having me.
That's all for now, but you can see all segments featured in today's show on YouTube at youtube.com/boombustrt. We also love hearing from you, so please check out our Facebook page at facebook.com/boombustrt. You can also tweet at us at Aaron Edward NH, he's not here today, and at
Curious_Kurz.
There you go. From all of us here at Boom Bust, thank you for watching. See you next time. Ciao.